All right. So talking about an auditor's report, because this lecture is going to be all about an auditor's report. First of all, focus on the things that I'm about to tell you. If I go back towards the introduction class that I provided you with the thing that we did live upon the introduction class, I told you about many different things like what are the stages of an audit. First, we have to look at the ethics section. Are we ethically neutral enough to accept this client or not? And then we go towards acceptance of the client. Then we move towards the audit risk section. We try to identify the risky areas in the financial statements. And then after identifying the risky areas, we develop ourselves, we plan accordingly, like what would be the appropriate recommendation we are going to get to the team, going to give to the team. After this audit risk section, we move towards the substantive procedures section. And I told you a very important thing that substantive procedures is mostly applied on the areas which have higher risks. So the risk where the risks have been identified within the financial statements, where there is a lot of risk, that is the specific area where we identify a lot of, where we apply substantive procedures and identify whether this amount is correctly recorded or not recorded. After moving towards substantive procedures, we move towards internal controls and identifying the deficiencies within the internal control, giving the management appropriate recommendation, appropriate knowledge how the management can properly manage their internal controls, properly use the internal controls to make sure that the fraud and error is reduced within the financial statements and it is reduced within the company itself. After doing internal controls, the next step was to give a review, take an overall review of the audit, check out many different things, which included subsequent events, which included going concern, which included evaluation of misstatements, taking written representations from the management, and finally reviewing whether the audit that is done by us, whether it has been done correctly or not. After this, the final thing that we used to do, because we have gotten we have obtained all the evidence we need, whether the financial statements are correct or not, we have to give an opinion. We have to provide an opinion whether the financial statements are correct or not. And based upon this opinion, many of the stakeholders are going to make the decisions based upon the financial statements. Dependent upon our decisions, the stakeholders are going to make a lot of decisions upon the financial statements. So the basic knowledge that you need to have is that an auditor, I told you within the first lecture, an audit report is a one-page document on which the auditor briefly explains every single thing. Like, how did we do the audit? What did we do during the audit? What was the most important thing during the audit? And what is our opinion about the financial statements? These are the things that the auditor has to explain. If you remember clearly about statement of financial position, statement of profit and loss, what was the presentation criteria of these two statements? Like, first, within the statement of financial position, non-current assets come in. Within non-current assets, the first thing is PPE. The second thing is intangible assets. The third thing is investment properties. The fourth thing is blah, 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 so on and so forth. Then comes the current assets. Within current assets, the first thing you write is always inventory. Then the second thing is receivable. The third thing is cash. In statement of profit and loss, the first thing always is revenue. The second thing was always cost of sales. Then came gross profit and so on and so forth. You even learned this within F7, within F3. Like, you can't change this pattern for the financial statements. If you want to, you cannot present the current assets first and then after that you can present non-current assets. No, no, no. You are not allowed to do this. You can't show first of all the intangible assets and then show the property, plant and equipment. No, you can't do this. Same is the case with statement of profit and loss. If you want to write down cost of sales first and then write down revenue, this is not allowed. You have to follow this pattern. And you can't even do this, that what if I just skip out the cost of sales? What if I don't include this? You can't even do this. This is known as presentation of financial statements. This has to be followed. The presentation has to be followed wherever the financial statements are being made. Even if you talk about USA, when there is gap applicable there, they're not IFRSs and ISS. Still, the financial statements all over the world are made with the same presentation that you have learned. They will never change. Just that way, just the same way, according to the financial statements, an audit report has its own presentation, which must be followed by the auditors. Like, you need to have a specific pattern of how you are providing every single thing or writing down every single thing within the audit report. So that, and why is this required? So that all over the world, the audit report is harmonized, the same for whichever auditor you choose the audit report from. Let's say you chose an audit report from Grant Thornton within South Africa. If you look at that audit report versus if you look at an audit report from KPMG within UK, they both will always have the same pattern. And as a student, you have to learn this pattern. What comes first? What comes the second? So let's move towards the notes where I have written down this pattern and you have to learn it. First of all, ignore this side at the moment. Ignore this side. First of all, we are going to study about the normal auditor's report. Normal also means unmodified audit report, the normal type of audit report that an auditor always makes. In this audit report, the first thing that is included is always the title. Give me a second. Let me open up an example auditor's report in front of you. Give me a second. All right, come back towards the lecture and see what I'm going to show you right now. The first thing that you always include within the auditor's report is the title of the auditor's report, which means you have to include a heading. What is this report about? So if I open up an auditor's report of Nestle for the year ended 2023, you can see report on the audit of the financial statements. This is the heading provided to this auditor's report. This is always the first thing that is included within the auditor's report. So this is the type of heading that you should remember in your mind, that this is the type of heading that is always given within an auditor's report. If I come forwards, the next thing is addressee. What is meant by addressee? The person to whom you are trying to give this report to. Like, for example, if you are writing an application towards in the school that you study from, in the university you study from, obviously you would write down like, I am giving this application to the class teacher or to the principal. This
is
is
it their
how
address or not that?
Yes, come again.
Is it their address or it's not that?
Addressee, the person to whom you are giving this report to, you have to write down the name. And obviously, to whom do we give the report to? To all the stakeholders of the financial statements, not just the shareholders. So the specific name used for that within majority of the companies is to the annual general meeting of Nestle Corporation, because in annual general meeting, all of the shareholders, the stakeholders, every single person would be present there. Got it? So the Nestle's auditor has basically took the addressee as the annual general meeting. Addressee can be anyone. If this, for example, if
So
we
just put your
are
address
auditing
in.
shareholders, then our addressee would be to the shareholders of XYZ company. If you are auditing for the bank, then our addressee would be to the bank XYZ corporation of this company. So the second thing is the addressee, to whom the financial statements are being delivered to whom this audit report is entitled towards. The next thing included within the auditor's report is auditor's opinion. This is a paragraph heading. In this paragraph, you give your own opinion. Now, for the exam, you don't need to remember how is the paragraph written. That is not something that you need to remember for the exam, but you need to remember the methodology, the pattern of the report. This is something that you have to remember. So what is written within the auditor's report? What was the normal opinion given by an auditor when there is no mistake in the financial statements? We have audited XYZ company, and according to our understanding, the financial statements give a true and fair view. So if I open this financial statement up, look, the next thing is opinion, auditor's opinion paragraph. So here they have written, we have audited the financial statements of Nestle Corporation for the year ended 31st December 2023.
Wait.
Yes, come again.
So the auditor's report is not that detailed. I thought it would be like more
I
detailed.
just told you, you don't need to remember this. You just need to remember the pattern of how it is done.
Okay.
Okay. You don't need to remember these things. If you need to remember something, I'll let you know about it. But you don't need to remember how is it written. I'm just reading it for basic understanding. So it is written, we have audited these financial statements as well as these financial statements. In our opinion, the consolidated financial statements give a true and fair view of the group's financial position, financial performance, and cash flows. So basically, the auditor is saying overall, the opinion is that the financial statements give a true and fair view. This means that the auditor has completely audited and they have found no mistake in the financial statement. So this is an auditor's opinion paragraph in which basically the auditor has to give an opinion. Either the financial statements are giving a true and fair view or are they not giving a true and fair view. This is what the auditor has to state. In short, this is what it means. The next thing is known as basis for opinion paragraph. In basis for opinion paragraph, and by the way, if you are writing everything down like what is included here, you don't need to write it down because I have written down in summarized way like what is included here. This is not something that you need to learn, but you need to have a basic understanding of so that you know what is basis of opinion. So I'm not moving towards this. I'm just providing the explanation like what is basis for opinion. So let's talk about basis for opinion. If as an auditor, you gave an opinion that the financial statements are giving a true and fair view. This was opinion. This was your opinion. True and fair view is being provided by the financial statements. You also need to tell to the stakeholders of the financial statements, like how are we giving this opinion? Why are we giving this opinion? What makes us think that the financial statements are giving a true and fair view? How did we determine our opinion? You also have to provide this explanation. So if I open up the auditor's report of Nestle, look what the auditor has written here. We conducted our audit in accordance with good auditing practice in Finland. Our responsibilities under good auditing practice are further described in auditor responsibilities. Leave it for the audit of financial statements. We are independent parent company and blah, 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 blah. Whatever the auditor has written in our best knowledge and understanding, the non-audit services that we provided to the company do not create an ethical threat. The auditor has also written this. We believe the audit evidence we obtained is sufficient and appropriate to provide basis of our opinion. So basically, in this paragraph, the auditor is further explaining like how did we actually provide our opinion? How did we actually provide our opinion? If we are saying the financial statements give a true and fair view, how did we obtain that opinion? Did we get enough evidence? Did we make sure we were ethically correct? We did every single thing correctly and then we gave this opinion. So the auditor is further explaining how exactly we determined that the financial statements either are giving a true or fair view or either they are not giving a true and fair view. This is what the auditor writes down within the basis of opinion paragraph. The next thing, which is a bit difficult to understand, it is a bit trickier thing to understand, but I'll try to make it as much easy as I can. Key audit matters. The next paragraph is always of the key audit matters, and always remember this is only included for listed companies. For non-listed companies, this is not included within the auditor's report. This is always skipped out. Got it?
Okay.
Great. So now what is included within key audit matters? What is, by the way, key audit matters is also known as CAMs. In your practical life, you will never listen to an auditor saying key audit matters. He will always call it CAM. Key
What's it
audit
called?
matters.
CAM. What
It
do you
is
mean?
always known as CAM within the practical life. Key audit matters. No
KAM.
auditor calls it key
KAM.
audit matters. He always calls it CAM. So never
Oh,
get
CAM.
confused in your practical life. Now, the important question is what is included within key audit matters paragraph? I will move towards the notes which are included right here. But first, I need to give you a basic understanding. Let's talk about CAM. What is included here? Included within CAM. During the audit, you
Mhm.
might have identified some areas where there was a lot of difficulty for you to audit. And difficulty can be because of many different things. Either the management was not actually providing you all the information you needed. Either there was a lot of risk there. Like, for example, if you identify that there is a risk in revenue, and then you have this second sense saying to you, this risk is the most riskiest place. This place is the most riskiest place within financial statements. This is what you determine. So there are many different criteria based upon which you determine CAM. Areas where you faced a lot of difficulties, areas where there were a lot of risks. I have written these down. I will move towards the notes. Leave that portion. These are basically included within CAM. Now, the second question is, how is it included within CAM? That is also something very important to know. So as an auditor, within the CAM paragraph, within the auditor's report, you will create two, just like audit risk sections where you used to create two columns, an auditor will also create two columns. So in the first heading, he will give the name area, and the second heading would be procedures. Auditor will write down the name of the area, revenue. So this means that now the stakeholders of financial statement automatically know that either the auditor has faced a lot of difficulty within revenue audit or there was a lot of risk there. The auditor in below risk, the auditor will further explain like why this has been included within CAM. He will give a brief detail about it. He will explain, was there a lot of risk there and why was there a lot of risk, or did we face any kind of difficulties during the audit of revenue? And why did we face the difficulties? So he will further explain like why did we include it within CAM? Okay, any questions up till now?
No.
Great. In the next section, he will approximately write down all the substantive procedures he did upon revenue. All the substantive procedures line by line will be written down that he did against this significant area that he has written within CAM section. So what does this state? What is meant by when you include this? So within CAM, first of all, remember, the auditor will not only include revenue, he might also include salary expense. He will explain the reason why it is included within CAM. Either there was a lot of difficulty auditing this, or either it had a lot of risk. And then he will also again write down all the procedures he did against the salary expense. What is meant by this? Why are you including this CAM section within your report? The stakeholders of the financial statements of listed companies need to know which areas are very risky in our company. All the stakeholders need to know this. And then they also need to know how did the auditors audit them, so that the stakeholders can provoke any kind of action upon the auditors if the auditors did not do appropriate type of procedures. Got it?
Wait, what? I don't understand. No, no, no.
If the auditors, listen very carefully, if the auditors are saying that either the risk was very high in revenue, or either we faced a lot of difficulty during the revenues audit, they then should have used lethal procedures, right? Lethal, they should have created lethal substantive procedures. Very good substantive procedures should have been done by the auditors. For example, an auditor is including revenue within CAM section. This simply means that either the auditor faced difficulties or either there was a lot of risk. And here he is writing down procedures. We checked the disclosure, we checked the arithmetical accuracy, we took a written representation from the management, and we took a verbal communication with the management that is the revenue correct or not. We only did these procedures. And by including these procedures, the stakeholders of the financial statements will clearly know what work did you do upon the revenue, which you are saying had a lot of difficulty during the audit. What was the way you identified that whether the revenue is correct or not? The stakeholders need to know it. So if the auditors are not doing something correct in these highly important areas, the stakeholders or the shareholders, whoever they are, they can raise concerns upon the auditor that this was not audited properly. Got it?
Okay.
Got it. Great. Let's move towards the notes now, because note is important here. Key audit matters is only included for listed companies. You should know this. Key audit matters are those that in the auditor's professional judgment were of most significance in the audit and are selected from matters to be communicated to those charged with governance. Leave this line for now. Leave it. Just read it till which were of most significance in the audit. For non-listed companies, the auditor is not required to include a key audit matter paragraph, but may voluntarily do so. So this line simply means that for non-listed companies, an auditor, if he does not include the CAM section within his auditor's report, they have no obligation to do so in the first place. But still, if they want to, voluntarily, they can do it. But they are not required to do it. But for listed companies, they are required to do it. Understood?
Okay.
Great. The next thing, the matters are included to ensure that the users of the auditor's report have an understanding of the entity, and users would be able to use the understanding to engage in communication with management and those charged with governance. So any area that you are including within key audit matters paragraph, CAM section, you are including there, obviously those areas would be of more concern to the users of the financial statements. If they want to ask the management any type of question in the AGM, in the annual general meeting, they are the areas where the users of the financial statement would most probably want to ask the questions from the management, like how did you calculate revenue? Please tell us, management, because the auditor has included this section within their CAM. This means that this is really significant. This is really important. Got it?
Yeah.
Great. Now, key audit matters include areas of higher assessed risk of material misstatement or significant risk identified in accordance with ISA 315, identifying and assessing the risk of material misstatement. So basically, this is a standard. You don't need to remember the name of it. Just for the basis of understanding, I have included it here. That key audit matters, first of all, include all the areas where there was a lot of audit risk involved. Like within revenue, I told you this I think when we were studying audit risk section, I told you this very importantly. In practical life, there are always two areas where the auditors always include a significant, a very big risk by default. That is revenue and management override of controls.
And
Okay.
equity.
I'm just telling you this. You don't need to remember
How about
this for the exam. So all the areas where there
how
was
about equity?
come again.
How about equity?
No, equity is not a highly assessed risk.
For some reason, I did a question.
Hmm.
It says it was like which one is just risky by nature, and then equity was the answer, and it was an
No,
MCQ.
equity is not the answer. It depends upon
I
the
found
scenario. You can't stay that. You can't just there won't be a simple question given and the auditor would have the examiner would have asked which of the following are
it was
more.
linked to the question.
There must
Though.
be a scenario linked with it, a
Yeah, it
story.
was
From the story, you had to identify which of the following are the more risky areas.
true.
Okay. So you can't just like in the exam even as well, this question cannot be asked. The examiner cannot do this unless and until there is a story given to you. Based upon that story, you will read that story and identify where is the higher risk of where is the higher risk in audit. So from within that
Okay.
story, there would be something written like we have sold this much of the shares, and the management is really like not able to calculate the shares and not premium value. They have no experience in it. So then there is a lot of risk within equity. By default, there is no risk within equity. Remember this. The number two thing that is always included within CAM, significant auditor's judgment relating to areas in financial statements that involve significant management judgment, including accounting estimates that have been identified as having high estimation uncertainty. What is meant by this? What is meant by this? Can you let me know what is
Asking
meant
me.
by this?
Asking me.
Yes. What is an estimate?
Estimate is like when something is going to happen in the future, so you predict it now. But
Yes.
then, estimation uncertainty is like,
Okay, let me explain it
is it
in
like a small change will have a big impact? I don't know.
yes,
Like
yes,
that.
yes, yes, exactly. Yes, yes. So I have a question from
Yeah.
you. I have a question from you. When we talk about
Yeah.
the word estimate, always remember that estimation is linked with judgment. When there is a judgment involved, there is always an estimate there. Always an estimate there whenever there is a judgment. When I talk about IS 16, IS 16 does not tell you what is the life of the asset you choose. It only gives you a statement. The life of an asset should be used upon which it will be able to provide you economic benefits. Now, you are the one who has to decide what would be the economic benefit we are going to receive from this building. You are the one to decide that. So management is using their own judgment and then estimating further on the life of the asset. Based upon this estimate for the next 50 or 70 years, the depreciation would be calculated. So if the life of a building changes from, let's say, 50 to just 51 years, the impact of depreciation charge would always be material. It would have a lot of uncertainty in it. So this is known as estimation
This is the way.
uncertainty. Remember, whenever there is a judgment involved or wherever there is a judgment involved of the management, because the standard did not tell you about it. Whenever there is a judgment involved, obviously, then during the audit of this company, the auditor would again have used their own judgment to determine whether the life being used by the management, is it correct or not? The auditor would have used their own judgment there as well. So wherever a management is using a judgment, first of all, the first statement is always remember wherever the standard is unclear, the management will always have to use your judgment. And whenever a judgment is involved, there is always an estimate there. And whenever there is an estimate, the auditor has to use their own judgment there. The three cases are
What do you mean?
always similar to each other. None of the three cases would happen alone. They would always happen along with each other. So
So what are you trying to say?
just in simple words, remember, wherever management has made a judgment to determine something, that area is always included within CAM. Got it?
So you're saying where anywhere management use judgment,
Hmm.
there's always income.
Yes, that is always included within CAM. Got it?
Yeah.
Great. The next point, the effect on the audit of significant events or transactions that occurred during the period. What is meant by this, by the way? Can you let me know what is meant by this?
The effect on the audit of significant year.
Okay, let me tell you something very
I
important.
don't know.
Let me tell you very important. PP, let's talk about property, plant, and equipment. Let's say in 2012, my property, plant, and equipment had a total value of $1 million. After all the depreciation charges, everything, my value of property, plant, and equipment was $1 million. In 2013, my property, plant, and equipment had a value of $1.1 million. What is happening here? The value of PP is increasing. Either a revaluation must have been done, because after depreciation, the value should reduce. It should not increase. Either revaluation should have been done, or either a new asset has been included. Always remember this. Whenever something new is included within any head of the financial statements, it is always included within CAM. Whenever there is something
What do you mean?
new addition within the statement of financial position, it is always included within the CAM section. So because I bought a new asset, it is something new that has occurred during the period. It is a new thing that has occurred during the period. All of this PPE balance would directly go to CAM. The PPE would
Wait.
now be shown
So,
as
so what happened between the last audit and this audit? New things that happened. So what you mean?
no. This is not what I'm talking about.
I
Anything
don't get it.
new that is included, like getting a new asset, a new
In the
customer
year.
comes in. Okay, some different type of inventory is bought, some inventory that you were not buying previously. Like obviously, when we talk about inventory, every single year new inventory is included within the company. Every year new inventory is bought within the company. I'm not
No,
talking.
what I'm saying is, I think
Mhm.
about like, what happened in the year.
Yes, what happened in the year? What happened in the year?
Okay.
So in short, remember this. Anything new that is included and it is unusual, not a normal thing that occurs. This is always included within CAM. This is the basic thing that you need to
Wait,
understand.
what?
So let's suppose, let me give you an example. Let's talk about inventory. Every single year, I buy 1,000 or 2,000 or 15,000, 17,000 different mouse that I sell to my customers. Every single year, my new inventory is included. So would this be included within CAM? Remember this statement. Anything new that is unusual, only
No,
that
no,
is
no, no.
included within CAM. So when I talk about inventory, every single year,
No,
I'm buying 15, 16, 17,000 new mouse every single year to sell to my customers. Would that be included within CAM?
no,
No, obviously no. Because
no.
yes, that is new. Yes, that is new, but it is not unusual. So let's suppose this year, the company has also bought 1,000 keyboards. And never before today's this year, the company ever did that. Now it is now unusual, something new that is unusual. This would be included within CAM. Got it?
Mhm.
Great. Any
So the whole
question?
inventory will be included in CAM. Is the whole inventory balance or just that?
Just that. Just that.
Wait, just the new, it's not the new
Yes,
stuff.
just the new things. Just the new things.
Okay.
Okay. Let's talk about another example. Let me give you another example. The company that I'm auditing, it has been around since the last 20 years. The company has never taken any loans. And this year, the company took out a loan of 1 billion. Would that be included within CAM?
Yes.
Yes. But let me give you a very difficult example to understand. Every single year, I have a bank, and that bank is very close to me. Like I have a very good relationship with this bank. Every single year, this bank gives me a loan of around $1 to $2 million. But during the year, I always return that. I never keep that loan until the year end. So no non-current liability, current liability is recorded when we talk about a loan. Am I speaking correctly or not?
Okay.
Okay. So let's say this year specifically, I took out a loan and still I haven't returned it. Would that be included within CAM or not?
It will.
Yes, because it is unusual. You always used to return this loan. Let me give you another very beautiful example of this. Every single year, again, I take out a loan from my bank that with which I have a very good relationship with. Every single year I do it. And every single year, I don't return it, I return it the next year. So it is recorded as a current liability. Every single year, take out a loan of 1 to 2 million. This year specifically, I have been given a loan of 500 million.
It will be included.
Yes, it is new, but it is also unusual in the case that such a huge amount has never been taken out as a loan before. Got it? Now, the second thing that you need to remember for this last statement is that for the exam, first of all, this will not be asked in detail. Only the first criteria and the second criteria are sometimes asked within the exam. The examiner will give you a list. I haven't seen any type of question. The examiner will give you a list and he will ask you which of the following should be included within CAP. And he will give you a story like this is something new that has been added. This is here we identified a very huge amount of risk. So it will be very easy for you to identify these types of things, whether they should be included within CAM or not, because the first and the second point are really easy to understand. But when we talk about the third point, in practical life, because audit is based again upon standards, the ISAs, International Standards of Auditing. The standard that deals with audit report has not further clarified like which new transactions do you include or not. The only statement that has been given to us, new and unusual. Only this statement has been given to us. So when I talk about practical life, again, the auditor's judgment is based to determine whether this is unusual or not usual. The auditor's own judgment is involved there. But for the exam, there is no question, first of all. But because this is in syllabus, the examiner might ask a question. In every single attempt, I tell the students the same thing. Always remember these
What?
two things. If
Which
anything
one?
you identify, it is new and it is unusual at the same time, always include it within CAP. Got it?
Wait,
Here,
new and unusual always in count.
anything that is new and it is unusual, that is always included within CAP. Okay?
Cool.
Now,
Mm-hmm.
for the exam, also remember this. Also remember this. I just gave you an example right here that an auditor, when he has to include something in CAM, he further explains it and writes down all the procedures that he has done. Right? This is what I told you. This is not included within your AA syllabus. The examiner can never ask a question from you that this something that we are including within CAM, what should be written within the CAM section and what procedures should be written against it. This is not a question that the examiner can ask because this is not within AA section, but this is within AAA. Yes, not within AA itself. Within AA, the maximum an examiner can do is that he can give you a story and for 2 marks or 3 marks only, he will tell you to identify which of the following should be included within CAM. That's it. Got it? But there is no such question up till now. No such question up till now. Within your kit as well, within the past papers as well, there is no such question. But you have to be prepared for it because what if the examiner does it? What if the examiner asks? Any questions up till this point? Can we move forward now?
Yes.
Great. Now let's come towards the next area, that is the next paragraph that is always included within the auditor's report is known as other information. What is other information?
Additional information.
But what addition? Yes, you are right. When you talk about the definition of the words, the literal definition, it means additional information. But which additional information are we talking about? You see, let me come towards the annual report of Nestle. We talked about the financial statements, right? These are the financial statements of the company. In total, including the disclosure notes, the financial statements of Nestle for 2023 are fully covered up, including the disclosure notes as well, including every single thing. They are just covered up in how many pages? In 50 or 60 pages. But this report itself has how many pages? 200 and plus pages. So what else has been included within this report, by the way? Let's check it out. What else is included within this report? Let's read it. So let's come up. These are only the financial statements. We are still at the financial statements. We haven't moved beyond. Okay, now look. Only after this, the financial statements start. After page number, you can say 177, the financial statements are included. After this, there are only financial statements, nothing else. But what about these information that are also given to the users with the financial statement. So any user, just like me, we are checking the financial statements of Nestle. I'm not just checking out the financial statements, right? I would also be reading the other information that is given with this financial statement. This is something that is not required by ISS and IFRSs. The management of the company has decided upon themselves that we will also write all of these things down and we will also give this to the users as well, in addition to the financial statements. So there is a problem right now. And can you identify the problem? You have now completed the syllabus of the audit. Can you identify the problem here?
Wait, it just went off 1 second.
When we talk about the financial statements and all the other information that is given with the financial statements, what is the problem that can arise?
I don't know. What are you talking about? That on what area?
I'm not talking about a specific area. I'm just giving you a statement. Do you understand what is other information, Omi? Do you understand what is other information?
No.
Okay. Let me tell you again. This is the annual report of Nestle.
Mm-hmm.
Only after this page, the financial statements have been included. After this page, the things that have been audited by the company have been included, right? The statement of profit and loss, the statement of comprehensive income, the statement of financial position, the cash flow, the changes in equity. These have been audited by the financial auditors, correct?
Sure.
But within this report, in excess to the in excess to the financial statements which have been audited by the auditors, in addition to that, all this information that is included before the financial statements, was this audited by the auditor? This information that I'm scrolling right now, this is not financial statements. But the company, the management of the company has decided that we are going to include all of this other information with the financial statements, and the auditor cannot stop them because this is an annual report. Within the annual report, the financial statements and all of this other
Wait, I
information
thought the
has also
auditors.
been
I
included.
thought the auditor. Wait. I thought the auditors had the auditors report.
Auditors write the auditor's report, and yes, they have written the auditor's report. We are talking about other information. All the rest of this information. Okay, let me come to the index, please. Let me come to the index. Can you see on the screen?
Yeah, no, you can see.
Where are the financial statements? Right here. Right? Which I have highlighted. Right here are the financial statements, correct?
True, yeah.
Yes. So all this other information from here before, all this information is something that is not related to the financial statements, but has been included in this report that is prepared by the company itself. These financial statements are something that were audited by the auditors. The auditor's report was written by the auditors. The company just took these financial statements and the auditor report and included this within their own report that will be given to the users of the financial statement. But the users will also read all of this other information that is included within this report. I'm not talking about the auditor's report. This is not an auditor's report. Auditor's report is just upon page number 259. The financial statements are on these pages. This other information that is also included within this report that is made by the management, this is something that was not audited. What
But then I thought we were
understand?
talking about.
Yes, come again.
I thought we were talking about what's in the audit report, though.
No, no. Other information is not about the auditor's report. This section is
Can you
not
go
about
back?
the auditor's report. When I use the name other information, okay, let me tell you something very important. Other information means that when companies give their financial statements to the users, they also give the financial statements and they give some other reports to the users of the financial statements themselves. Like, for example, there was nowhere this disclosure requirement that the company would have to state, okay, we are making, you studied within FBT pestle analysis. You will see within the audit, within the company's own report, they have done a pestle analysis on themselves. And this has been given to the users in addition to the financial statements as well. So when a company is giving their audited financial statements to users, not only the financial statements are given, rather the company would also give them some other information as well. Like, what do our directors say about the company? What does our chairman of the non-executive director has to say about the company? What does our CEO has to say about the company? There are these reports included as well, which is known as the remarks of the CEO, the remarks of the chairman, the remarks of the board. What do they have to say about the company? So a statement given by the CEO will also be printed upon a page and will be given with the financial statements. Were these statements audited by the auditor? Yes or no?
No.
No. And the auditor plus is not required to audit these financial statements under the auditing standards. The auditor is not required to do this. The auditor does not have to do this. But the fact is, what if I show you a very important thing? You see here it is written, this is, look what is written here. CEO's review itself. So this is a statement that has been given by the CEO of Nestle. Now imagine this situation. Imagine this situation. The auditor has audited the financial statements properly, and they know that in the previous year, the revenue of the company was 1 million, and in the current year, the revenue of the company is 250,000. This means 0.2 million. Overall, the auditor knows that the revenue of the company has fallen, the profitability of the company has fallen, whereas in the CEO's review of the company, in the CEO's statement, that has been given to the users, it is written in the CEO statement that our company is getting their profitability up and running. My company is working really good. The employees are working overtime, and we have been able to increase our revenues. We have been able to increase our profitabilities. Our banks are really dependent upon us. Our banks really trust us. All the stakeholders love Nestle. Our customers are increasing day by day. These kinds of statements have been given by the CEO in his own statement. Whereas when you were
So
auditing this company, you found out that nothing like this has actually happened. So when the
what do you
users
do?
read these financial statements and read these statement given by the CEO, the chairman, the board of directors, the non-executive, the executive directors, all of them have their own statements printed upon a piece of paper, which is given to the users of the financial statements. Wouldn't they be conflicted? Because they are
Yep, they will.
one type of information from the financial statements and some other information is being given to them by these remaining reports. Wouldn't they?
Yep. So what happens?
So what happens is that as an auditor, it is also your responsibility just to read these other informations that have been given to the users as well. Just read these, not audit these. You have the responsibility as an auditor to read these. And if they are materially different from what you actually expect it to be, they are materially different from that, then you have to write down within this other information paragraph that we have read all the other information and we have found out that the CEO statement that is being given to you, it is not correct. We found out that the chief executive statement, the chairman statement that has been given to you, it is not correct. And if it is correct, then the auditor states that we have also read this other information. And as an auditor, we believe that these other statements that you will be getting with the financial statements, they are correct. That's it.
So, so, so it's basically not included, but then it's part of it. It's like where the auditor gives their opinion on what the management said about the other information given.
Yes, correct. So let's read it from the notes itself. I've included it right here. When I talk about other information, what is written here? Other information refers to financial or non-financial information other than the financial statements and auditors report thereon included in the entity's annual report. So what is an annual report? Every single year, every single company makes their own report. This report is for 300, 400 pages in which much information is given to the users and every single stakeholder of the financial statement. Within this report that the company has prepared, the financial statements that have been audited are included, and the auditor's report is also included within this annual report.
In the annual report.
Yes, in
Wait,
the
wait, wait.
annual report.
Sorry.
So what happens is
Mhm.
that this would only be like 50 to 60 pages in total, including the financial statements and the auditor's report. All the remaining 250 pages have not been audited by the auditor, and the auditor is not required to audit this. So the management can write down anything within this section, anything within the remaining 250 pages. Like we are in contract with a very big customer right now who is going to buy billions of dollars of products from us in the near future, which has been the case in the past within UK. A very big company did this. A very, very big company did this, which led to the fact that even though the financial statements of those companies which were audited and they were correct showed that the company is making huge losses, but based upon this wrong line that was written, wrong information that was given to the users still invested millions and millions of dollars within that company, and every single user lost that money. Why? Because that was not true. Got it? So as an auditor,
Okay.
you have to read all of this other information. What is written here? The auditor must read the other information section which the company will issue with the financial statements and identify any material inconsistencies with the financial statements or auditor's knowledge obtained during the audit. If any material inconsistencies are identified, perform inconsistency to identify inconsistencies and assess whether other information or financial statements need amendments. So basically, you will first of all identify, okay, this kind of statement is given there. Would it affect the financial statement, or is this statement actually wrong? Discuss with management and ask them to make adjustments like they change this statement, please. This is a wrong statement that you are including. If management refuses to make these adjustments, then communicate it with those charged with governance. This means that you have to then communicate to the audit committee if the management is refusing to change those statements. If the matters remain uncorrected, then the auditors must describe the material inconsistency in other information section. The auditor may also resign from the engagement if allowed under the law and regulations, as this casts a doubt over management's integrity.
That's crazy. Okay.
Got it? So the basic thing that you need to remember is the auditor has to read all the other information within the annual report. And if they find any kind of material inconsistencies, they first have to discuss with the management and tell them to correct it. If the management is not correcting it, then you discuss this with those charged with governance, which are known as the audit committee. If they even refuse to correct it, then you have to state within your other information section that we read these all reports and we found out this material inconsistency. So we are just letting you know about it. Got
So
it?
first, wait 1 second. You read the other information,
Hmm.
and then you ask management to change it.
Yes.
If they refuse, then you tell the people charged with governance. I thought that external auditors they don't like you talk to the audit committee.
Come again, come again.
I thought the external auditors are like they like mostly talk to the audit committee.
Yeah, because the audit committee is the papa of the company, by the way.
So like why are we including management?
Come again, I did not understand what
So why? So basically, from what I know, the external auditors are like they talk to the audit committee, and then if they need any change, anything that should be adjusted, audit committee, this is the audit committee. But then here, how come they're like in conversation with the management directly?
Well, because Omi, your question is why do they talk about every single thing to the audit committee?
No, my question is, I thought if they had issues and stuff, they tell the audit committee.
No, 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 no,
But
no, no.
from this,
Your
it's
question is
saying
valid. You won't directly do that. Your question is valid. It is 100% valid. But I told you there is a way to do everything in the field of audit. You can't just get up and say, I'm directly going to the audit committee. Why don't you first discuss with the people who actually made the financial statements? Who are making the financial statements? The audit committee is not making the financial statements. Remember this. The
yeah.
financial statements are being made by the management themselves, who are basically the assistant managers, the senior managers, the directors of the finance department. They are the ones making the financial statement. So first discuss it with them. Because if they agree to make the amendments within financial statements, make those changes, why would you need to go to the audit committee? Because within audit committee, non-executive directors sit there. And I told you once very long ago within FBT, I told you for every single or the people, the non-executive directors get into a meeting, they have to be paid for that. So when an auditor wants to call the people that are in the audit committee, obviously the company will need to pay to the people of the audit committee. Then why are you directly calling upon them? First, discuss it with the people who actually made that mistake. If they correct it, good. If they don't, then go to the audit committee. Then tell them they are not accepting this change. There is a way, there is a professional way to do something. Okay.
Okay.
Great. So the basic thing is the auditor has to read the other information. The auditor has to read all the other information and remember these steps. First, if there are inconsistencies, he will tell the management. If they refuse, then the audit committee. If they refuse, then you will say within other information, we have read the other information and the management of the company are still not making the changes. Hence, there is a mistake in the other information provided. So that the users know that the financial statements are correct, you can rely upon them, but do not rely upon other information. Got it?
Okay.
Great. Now let's come towards the next part, the next paragraph, which is known as responsibilities of the management. By the way, what are responsibilities of the management in audit, in financial statements, in generic? What are the responsibilities of management? Please
Prepare
don't
the
tell me
financial
you don't.
statements.
Please don't tell me you don't remember.
What do you mean? Prepare the financial statements.
Yes, number one, to prepare the financial statements. What was the number two?
When did I do this?
You did it in the first lecture. Subject matter. Who is required to prepare it? The responsible party. Who is the responsible party?
That's not a
The
question.
management. And then preconditions of an audit. Preconditions of the audit meant the management is responsible to prepare the financial statements in accordance with the applicable financial reporting framework. Number two, the management should have
They should
deployed and have
disclose.
appropriate internal controls to make sure that the financial statements will give a true and fair view. These were the responsibilities of the management.
Oh, so
These
the
are the
preconditions are responsibilities.
yes, come again.
So the preconditions were the responsibilities.
Yes, obviously the preconditions have to be agreed. This means, by the way, who is responsible for the preparation of financial statements of me? If I ask the question and you ask the question from you in a different way, if I ask this, who is the person who is responsible for making the financial statements? What would your answer be?
The management.
So, who's responsible? What is the responsibility of the management to prepare the financial statements? This is the first responsibility. Let me ask you another question.
To ensure
Who is the one who is responsible to make sure the internal controls are good within a company so that the financial statements give a true and fair view?
management.
So if I say that it is a
And then the
management's
third one.
responsibility to make sure that their internal controls are good and appropriate, that statement is also correct. So these are the
And
basic
the third one is
keys of the management. Remember that.
okay.
So basically, an auditor within this paragraph would only write down theoretically. It is not linked to the audit, nothing else. He just explains in this paragraph that the responsibility of the management was to make the financial statements which they made, and the responsibility of the management were also to make sure that the internal controls are present within the company, to make sure that the financial statements give a true and fair view, and the internal controls were also there. So basically, the auditor is just explaining the responsibilities of the management to the users themselves. So if I talk about responsibilities of the management, it is written here. You can read it afterwards. So, but just like there was, the expectation gap, blah, 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 different things. All of those, basically the responsibilities of the management are included here. That's it. Now let's come towards the next section. The next section is also theoretical. Auditor's responsibility. What is an auditor's responsibility, Omi?
Two.
Hmm.
Two.
Hmm.
Okay, they have three responsibilities. So
Yes.
they should I don't know. They should obtain sufficient appropriate evidence.
Yes, good. This is the primary responsibility of the auditor, that they have to obtain sufficient and appropriate audit evidence and to gather enough evidence to
They form
provide
an
an audit
opinion
opinion.
and then they report an opinion on whether the second one is they form an opinion on whether the financial statements give a true and fair view. And the
Yes,
third one is they report the opinion using the applicable, I don't know, terms, whatever they had
yes,
to, what they had to for
yes,
the standard or
yes,
whatever.
correct. Basically, the third one means that they have to do the audit following the applicable auditing standards. This is also their responsibility. So again, in just theoretical paragraph, the auditor will also explain his own responsibilities. So why is these two paragraphs included within the auditor's report? Can you answer that? Because obviously the examiner is not going to ask you to write
Or
down
the
the
management, the
responsibility for
gap.
the auditor.
Because like the expectation gap.
Yes, there is an expectation, but no, not the expectation gap. Expectation gap meant that the auditors audit every single transaction. This is not expectation gap.
No. Expectation, it has more than that.
Yes, if you are talking about the fact that there is an expectation where the user might believe that the auditors are responsible to make the financial statements, to minimize that risk of the expectation, to correctly tell the user that these were the responsibilities of the management and these were our responsibilities. So anything that was done wrong there, we are not liable for it. To reduce this kind of misunderstanding or expectation, this is why these two paragraphs are included. That's it. By the way, the examiner is not going to ask you it in the exam. Please explain what is included within responsibilities of management paragraph. Please explain what is included within the auditor's responsibility paragraph. This question cannot be asked. Okay. Let's come forward now. Within the auditor's report, this is the next one. What is written here?
Report on audit, legal and regulatory requirements.
Okay. Can you explain what is meant by this? Because I think that I've gone over it again and again within audit risk, within substantive procedures, and we have also studied these things within different questions.
What do you mean?
A few days ago, you asked me a question that, sir, according to IFRS and ISS, basically, you told me that we have to disclose the remuneration or every single transaction that is done with related parties, or basically the directors of the company, because they are key management personnel. You yourself asked me this question. What is the problem that I've made here? What have I done wrong in this question? And I told you a very simple thing. In that question, the company was following all the IFRS and ISS requirements and disclosing these transactions with the director. But the law itself said that the names of the directors have also to be disclosed. The names should also be disclosed with whom the transactions have been performed. Within IFRS and IS, the accounting standards do not require the name to be disclosed, but the law specifically in a country may require the name to be disclosed. Wasn't this a legal requirement? Wasn't this a requirement of law? This was, right?
Yes, it was.
Yes. So if an IFRS or IS was not requiring something, but the law required something, then the auditor has to give an opinion upon it separately, not with this opinion that the financial statements, are they correct or not. For law-based things that the company had to do to make sure they are following the law, they have to provide an opinion upon these things separately. Is the company
So they
following
give
all
an
the laws and
opinion if
requirements
the
or not?
company follows law.
Yes. Is the company following all the requirements of the law or not, or whether have they missed any kind of requirement of law or not? They report upon it separately. And this report, or this basically paragraph, not the report itself, this paragraph is included right here. Got it?
Wait. Okay.
So let me give you an example. CCG, Code of Corporate Governance.
Stop.
We have studied the Code of Corporate Governance, and I'm going to give you an example of two countries, UK and Pakistan, my country and the country you are living in right now, where majority of the ACCA students are based, where majority of my own students are based, UK and Pakistan. Code of Corporate Governance was basically developed by the government of UK to make sure that the companies within their country are properly run. And the same code was also used by the government of Pakistan within their companies as well, to make sure that the companies within Pakistan are also used well. They just copied and pasted everything and said that we are also following the UK's Code of Corporate Governance. Within Pakistan specifically, the auditors, whenever they are auditing a company, they have to audit. Basically, the companies, first of all, are required by law to prepare a separate statement, just like statement of financial position, just like statement of profit and loss, just like statement of cash flows. They have to prepare an additional statement. And within this statement, they state the number of non-executive directors in the company, the number of executive directors, the people who are working in audit committee, whether one person has financial expertise or not. So all the requirements of the code of corporate governance, all of them are explained by the company. Are we following these or following not? The auditor has to audit these. Now, this
Oh,
was a requirement of specifically law, not a requirement of any IFRS and IS standard to make this statement, right?
true.
Yes. So the auditor always audits these and includes a paragraph basically after what? After the auditor's responsibilities section within auditor's report, the auditors include a paragraph report on CCG. And this is it. He explains, we have also read the or audited the CCG report, and we have found out that all the explanations given by the management are correct. Got
What's
it?
an average auditor salary?
No, come again, come again.
What's an average auditor salary?
What's an average auditor's salary?
Yes.
Are you like going to
No,
make
it's just like no, it's just like you're doing too much work.
this is not too much work for me. This is repetitive work. Why do you think that the auditor's work is too much? Believe me or not, like work within a company is too much. The work within an industry is too much. An auditor's work is the most like relaxing work. Although, yes, the work is a lot, the pressure is a lot, but it is one of the most interesting and challenging jobs there is. And that is the only reason why you should choose audit. The auditors are also paid a lot, by the way. You should also know this.
Sure.
Okay.
I can't be an auditor because I have to run a company.
You should be an auditor for at least 3 years. That way, you will have a lot of.
Yeah, maybe that. Maybe that, but I want to like take over
Be
my
an
own
auditor for
companies.
at least 3 years. Always remember this, and it is my advice to everyone, whoever studies from me. Always become an auditor for at least 3 years. Because within these 3 years, you will learn a lot and you will be known once you complete your 3 years. The level of knowledge you have about the standard, the level of easiness you will face in preparation of the financial statements and making decisions, understanding finances, understanding every single thing, the level of that knowledge will be way, 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 way much above than any other person who has not been an auditor.
So
An auditor
I
has
don't know.
much detailed knowledge of it. The person who directly went to industry, directly went to a company, he will not be able to understand that knowledge. In short, my seniors, when I was starting my days of internship, when I was starting in those days, my seniors used to tell me one simple thing. And I was very confused, like, I don't want to become an auditor. But my senior always told me one thing. A person who has been an auditor for 1 year is equivalent to a person who has been within an industry or a company for 3 years. Because within this 1 year, you have looked at the financial statements of, let's say, 5 to 6 different companies. But this person, within 3 years, has only prepared 3 financial statements. Within 1 year, you have looked at 5 to 6 financial statements because this person has done 3 financial statements only in 3 years. So the level of knowledge is very different.
Yeah.
Okay, let's come back. The next thing that the auditor includes is his signature. A very important thing. Very, very important thing. Do I need to provide an explanation? Like what is a signature? Just a signature like this. That's it. Then the auditor's address, the address of his office, and then the
Like
date.
just the senior auditor or like is it everyone?
Only the partner can sign an auditor's report, not anyone else.
Okay.
Only the partner can sign the auditor's report. Then the auditor's address, and then the date on which the signature was done. Understood?
Yes.
These are the normal financial statements. And we are done with the lecture.